Aruna sat in her bustling office in Bangalore, surrounded by charts showing her logistics company's rapid growth. Her boutique delivery service was expanding, but her old fleet was struggling to keep up. To move forward, she thought, tapping her pen against a ledger, I need a vehicle that can handle the weight of our ambitions. It's time for a new commercial van. At the showroom, Aruna met Vikram, the senior dealer. He showed her a sturdy, gleaming silver cargo van. The price tag was significant, and a large portion of it was goods and services tax, GST. Aruna frowned. The tax alone is a massive investment, Vikram. It feels like money just leaving the business, she remarked, looking at the detailed quote. Seeking clarity, Aruna visited her longtime financial consultant, Sanjay, at a quiet cafe. She laid the quote on the table. Sanjay, I need this van for the business, but the GST is nearly 30% of the cost. Is there any way to soften this blow? Sanjay smiled, stirred his tea, and nodded. Have you considered the power of input tax credit, or ITC? Sanjay began to explain the concept. Think of GST not as a one-way street, but as a chain. Every time you spend money on your business, you pay input tax. Every time you earn money from your customers, you collect output tax. In the eyes of the law, the tax you've already paid on your inputs can be used to pay off the tax you owe on your outputs. Aruna looked over her records on her laptop as Sanjay continued. Normally, GST on personal cars is blocked. You can't claim it back. But because your business is specifically about the transportation of goods, that van is a, quote, capital good. The GST you pay to Vikram today becomes a credit in your electronic ledger waiting to be used. To illustrate the difference, Sanjay pointed to a man named Deepak at another table who was bragging about his new luxury sedan. Deepak bought that car for his personal commute. Because it's for personal use, he cannot claim ITC. The tax he paid is a sunk cost. He pays the full price, tax included, and that's the end of it. Aruna felt a surge of confidence. She realized that for her logistics firm, the van wasn't just a tool, it was a tax-efficient asset. She spent the evening reviewing her GST registration and her output tax liabilities, the GST she collected from her clients every month. Every rupee of credit from the van would mean one less rupee she'd have to pay out of pocket to the government later. The next morning, Sanjay walked Aruna through the final math. If the van costs 10 lakhs plus 2 lakhs in GST, you pay the 12 lakhs now. But when you collect GST from your delivery clients next month, you won't send that money to the government. You'll keep it, effectively paying yourself back that 2 lakh rupee credit until it's used up. Aruna returned to the showroom and shook hands with Vikram. She felt different this time, not like a spender, but like a savvy investor. She handed over the payment, ensuring the invoice featured her business's GSTIN correctly. This van is going to do great things for us, she said, her voice steady and proud. Weeks later, the new van was on the road. Draped in the company's vibrant logo, Aruna watched it depart from the warehouse, knowing she had made the right choice. By understanding the flow of tax, she hadn't just bought a vehicle, she had mastered a vital piece of the business puzzle, turning a tax burden into a fuel for her company's journey.